A responsibility of being a listed issuer, a listed company, is disclosure to the markets of particular events or transactions. And two are noted in paragraph 1.4, notifiable and connected transactions. Now, both of these types of transactions, details of which are given in the bullet points, must be reported. Indeed, with connected transactions, they need to be disclosed and are subject to shareholders' approval. So that's a responsibility of being listed. Now, under paragraph 1.5, we can have trading halt, suspension, cancellation, and withdrawal of listings. A trading halt is where the securities stop trading for up to 2 trading days. Beyond 2 trading days, we refer to it as a suspension. Now, the reason for a trading halt is usually the requirement that information needs to be disclosed in the market, whereas a suspension, the issues are a little bit more fundamental. There are problems, and we have listed them there. The bullet point starts off, stock exchange may direct trading halt or suspend dealings where, and there are 4 situations where the issue can be suspended. Any suspension should be kept as short as possible. Now, disciplinary procedures with regard to the listing rules, these are fairly not lenient, but tame. There's no fining, there's no imprisonment, but it's the listing division of the stock exchange or the listing committee that can commence disciplinary proceeding where the listing rules have been breached by the issuer. And the sanctions that can be imposed are listed there: private reprimand, public reprimand, reporting conduct to the SFC, other regulatory bodies, banning a professional advisor from representing an issuer appearing before the listing division or listing committee. As I said, no fining, no jail time. Okay, other types of listed securities as opposed to just the listed issue, the shares listed on the stock market. We have depository receipts. Details are given there under paragraph 2. You may have heard of American ADR, American Depository Receipts. Well, we have the similar products in Hong Kong. Now, warrants. There are 2 types of warrants. Subscription warrants and derivative warrants, although we're only referring to them as warrants. Now, these can be viewed as long-term options. They give the holder the right to exercise and subscribe for the underlying securities. So, for example, if HSBC listed warrants on the stock exchange and you purchased those warrants, they would give you the right to buy shares at the exercise price, and you would buy those shares under just warrants from HSBC itself. However, with derivative warrants, they're issued by a third party, usually an investment bank, a significant intermediary in terms of finance. And if you exercised those warrants, that would give you the right to buy the underlying shares, but those would not be the shares of that third party. You could buy the shares from them. But usually in practice, they are cash settled. That is, instead of an investment bank selling you HSBC shares at the exercise price, they would settle the difference in cash. So be aware, warrants are issued by the company whose shares are the underlying, whereas derivative warrants are issued by a third party, usually an investment bank. And they must expire not less than 1 year and not more than 5 years from the date of issue or grant. Debt securities, bonds, notes, yes, can be listed. It's not usually a difficult topic. And second bullet point there, we see holders are creditors, not owners of equity. Okay, we leave listings and we move on to takeovers and mergers and share buybacks. Now, with listings, we had the listing rules. With takeovers and mergers and share buybacks, we have codes. These are SFC codes, obviously, issued by the SFC. So the supervision of these codes and mergers, takeover activity in Hong Kong is not dealt with by the stock exchange. It is dealt with by the SFC itself, and more specifically the corporate finance division of the SFC. Second bullet point under 3.1, you will see the executive director of the corporate finance division, who we refer to in short as executive of the SFC, is responsible for the day-to-day administration of these codes. And we're then told the listing rules require compliance with the codes. So if you are listed in Hong Kong, you automatically have to comply with the codes on takeover mergers and share buybacks. Now, these codes are based on 10 general principles, and we've listed the main principles on page 8.11. That can come up in the exam, so be aware of the general principles underlying code and takeovers and mergers and share buybacks. Now, in these codes, we are introduced to the concept of mandatory offers. Now, as it says under paragraph 3.2, general principle underlying a mandatory offer is that if control of a company changes or is acquired or consolidated, a general offer to all other shareholders is normally required. It's where control is changing, then the codes say that whoever is taking control must give the other shareholders the opportunity to get out. They don't have to get out, but they have to make an offer. There are two situations where the mandatory offer can click in. First of all, any person who acquires, whether by series of transactions over a period of time or not, 30% or more of the voting rights of a company, and that's known as the trigger provision. And you will see in brackets, or two or more persons acting in concert. And acting in concert means two or more acting under an agreement or an understanding where they're actively cooperating to consolidate control of a company. Now, the second provision is any person, two or more, again, persons acting in concert, who own between 30 to 50% already, inclusive, not more than 50%, and then they acquire at least an extra 2% of the voting rights within a 12-month period, and that's known as the creeper provision. So be aware of the trigger, the creeper provision, because if they are triggered, creeped, then you must make an offer to all other shareholders. And that offer, the mandatory offer, must include a cash component, and the price cannot be lower than the highest price that the offer had paid in the previous 6 months. We're told the last point there that the executive has the power to grant dispensation from the need to make a mandatory offer under certain circumstances, but we're told it's not guaranteed. Now, voluntary offer is where you're offering to buy all the other shares, but you don't have to. It's not a mandatory offer. Unlike a mandatory offer, the voluntary offer does not need a cash component. In this case, the price that you offer cannot be less than the highest price paid within 3 months prior to the start of the offer period. There's a few points at the bottom of the page, paragraph 3.4 on share buybacks. Be aware of it, but rarely, if ever, examined. Now, disciplinary proceedings with regard to takeovers and share buybacks. Well, if there are any problems, any disciplinary procedures, it will be the takeovers panel of the corporate finance division that will look into it. And if there has been a breach of one of these codes, then the following sanctions can be imposed: from a private reprimand, public censure, requiring intermediaries not to act or continue to act, etc. Be aware of those sanctions that are listed. Okay, we're going to leave the world of corporate finance and now move into asset management. And we're going to look at two categories of SFC authorized products. The first collective investment schemes. And these, as it says, are covered by Part 4 of the Securities Futures Ordinance. Now, what is a collective investment scheme? A collective investment scheme is like a mutual fund, a unit trust, where you invest, you put money in, and then professional money managers will manage your money, hopefully making you a positive return. And read through the details and the definition, a little bit wordy. There are exclusions, but if it's examined, it's not problematic. Now, the big deal with collective investment schemes and the SFC is if the intermediary is going to offer a collective investment scheme, a unit trust or a mutual fund, to the investing public in Hong Kong, they must be authorized. Now, more specifically, it must be either structured as a company, which is listed on the stock exchange, and you would have to go through all the listing requirements, or authorized by the SFC itself. And as we've noted, that's the most common approach. Now, paragraph 4.1.3, advertisements. Advertisements inviting the public to invest in collective investment schemes must be authorized by the SFC. And again, we've listed some detail. And any misrepresentations in the advertisements or anything that's being put forward with regard to collective investment schemes can be problematic. You can be committing an offence. As it says under 414, can be a criminal or civil offence to make any fraudulent or reckless misrepresentations to encourage someone to invest in or dispose of investments. Although we point out there, journalists are exempt from licensing requirements. However, they can be still prosecuted for making false or misleading statements. Moving on to structured products. Now, I said there was two forms of authorization. The first was collective investment scheme. The second is structured products. Structured products were a big issue in 2008, and we had a number of products that went badly wrong in Hong Kong. And as a result, the structured product market is not as vibrant as it once was. And as a result, you tend not to see many questions on it. So I'm going to skip over that. I would like to then move on to 4.3 on page 8.16, codes and guidelines issued by the SFC with regard to the world of asset management and collective investment schemes. There is a handbook. They've issued a handbook for unit trusts and mutual funds, and that contains some of the codes that we need to be aware of. Now, the handbook sets out 7 general principles, not heavily examined. So flick through those, be aware of them. But you should be aware of the codes that the SFC has issued. The code on unit trusts and mutual funds is extremely important if you are in the world of providing collective investment schemes to the Hong Kong investing public, because to get your schemes authorized, you must follow all the requirements of that code. Now, it may be referred to in paper 1, but if you ever have to do paper 6, you'll need to know that code in a certain amount of detail. We have the Structured Investment Product Code, obviously relating to structured products. The Code on Real Estate Investment Trusts, REITs, a specific form of collective investment scheme, and the Fund Manager Code of Conduct, and that we looked at a certain amount of detail in topic 5. Paragraph 4.4 recognizes that there are mandatory provident fund products. It is the MPFA, the Mandatory Provident Fund Authority, that is the primary regulator, as we're noting, but the SFC does have regulatory oversight over mandatory provident funds because they are investment products being offered to the investing public in Hong Kong. Therefore, the SFC is responsible for authorizing offer documents and marketing materials and it has issued the SFC code on MPF products with regard to the authorization, and it also approves investment managers' scheme products. Now, you may be surprised to see the word approves. Surely they license investment managers. If the investment managers are operating in Hong Kong, yes, they will have to be licensed. But if they're operating overseas, and that sometimes happens with managed provident fund products, then the SFC will approve them. But in many cases, they are licensed. Now, who are the service providers involved in the world of authorized collective investment schemes? We have trustees for unit trusts, custodian for mutual funds, and these are the institutions who look after the investments on behalf of the beneficiaries in the funds, and have a read through and see who can be a trustee custodian. The management companies, these are the investment management companies managing the collective investment schemes. And again, read through the details, what management companies must adhere to. And we list the management and internal controls that they should be following. Trustees, custodians, and the management company of collective investment schemes must be independent from each other. Now, as I said earlier, management company, I'm under 454 now, management company operating in Hong Kong will normally need to be licensed or registered for Type 9 asset management, and a little bit on those that are operating outside Hong Kong, which I've already referred to. And then we come to the special requirements for parties involved in authorized, unlisted, structured investment products. Now, this material came into the exam a number of years ago, but as I said earlier, given the sort of lack of activity, limited activity in the structured investment products market in Hong Kong, the examiners appear to have slackened off. We don't see many questions at all. By all means, read it for your own interest, but I wouldn't be too concerned with regard to examination questions. The last section, which was recently introduced, alternative methods of accessing public capital. So that's bringing us up to date in terms of crowdfunding, initial coin offerings. Have a look at the summaries that are provided under paragraph 5.1 and 5.2. What's the SFC's position? Well, it says the SFC's issued a number of circulars regarding both crowdfunding and initial coin offerings, reminding intermediaries of securities laws that may apply. Unlikely that we'll see too much action in the exam on that, but be aware of it. Well, that brings us to the end of topic 8. Topic 8 covers listings, mergers and acquisitions, collective investment schemes, and asset management. Not all the material is going to be examined, nowhere near it, but to get an idea of the topics that have been examined, once again, go to the practice questions under Examinator.online, and you'll see the sort of thing that has been asked in the past.